Today, we're going to be talking about cash flow. My name's Drew. I'm the founder and CEO of Focused Energy. We do fractional finance, accounting, and operations. And what I'm excited about for today is to really explain to you some ways that breaking down cash flow to make it more digestible, easier to manage, and ultimately more effective for planning a business. Ultimately, with cash and cash flow, think of it like gas in a car. If there isn't any gas in the tank, the car's going nowhere. And if you have very little gas, you can't go very far. And so being proactive in being able to identify where is cash today, where is cash going to be, how do you manage it, and how are the activities you're taking on a day-to-day basis going to impact that? Things that impact cash flow are, what are your current customers? How do they pay? When do they pay? How much? Other elements of that could come into when you are invoicing your customers. Is it a milestone based, so you have to complete something before you can invoice? Or is it time based, so it's on a consistent schedule? These are all elements that will impact cash inflows. There's other elements of cash inflows that come from future customers. Call that pipeline. So what we just said was you have your contracted customers, and then you have your future, your pipeline customers. What we want to is we don't want to live in the land of hope and maybes, rainbows and unicorns. Basically bullshit that might not happen and that you're making big decisions on. And so we like to have very distinct segregation between what is contracted or known, you have an agreement on, and you know with pretty much certainty it's going to happen, and pipeline, which is probably always up and to the right, always looks really good. Having a distinction between the two and a way to look at cash flows distinctly and then separately and together, contracted and pipeline, enables you to start making more effective decisions more quickly. So when we look at cash inflows, for right now, some of the elements that you can manage and look at, most importantly, are amount, timing. And with the amount and the timing, what we're wanting to understand is when you have the cash flow in, let's say it's you invoice every month. And that amount is going to be $100 every month. Great. Wow, look at how consistent this is. Awesome. Your payment terms, though, are net 30. Okay, so your revenue most times is going to be very different than your cash. Your revenue is when you earned that cash. The cash is when it hit your account. And there's some dislocation between cash accounting and revenue accounting. Cash accounting only truly represents your cash if you never invoice and you don't enter any bills. This is generally the way it works for like QBO or Xero. Some other systems have a way to account for that, but that's why there's some confusion when your quote unquote cash reports don't match what hit your bank account. When you create an invoice, for example, QBO is going to record that on the invoice date, not when you actually did get paid. So there's a big difference here, so you want to be a little careful of it. Generally, there's also accrual-based accounting. Even recognition of when revenues were earned, when expenses were incurred, the matching principle to match revenues and expenses. And so we're not talking about revenue today, whether cash or accrual. We're talking about true cash. So let's pretend, for example, these $100 invoices that you've been sending out every month were on net 30 terms. So you're going to get zero cash in month one, because you invoiced day 0 of month 1, so you're not going to get paid for 30 days because you have net 30 terms. Maybe they pay sooner, but highly unlikely they're going to. So great, this is what your cash receipt looks like. That's month 5. So you see all of a sudden, your cash flow inflow is way different. 0 month 1. Well, what if you have all these expenses like staff, rent, paying for other services? Yeah, if you don't already have cash in the bank, you're going to be kind of shit out of luck here. Knowing how those timings are different between revenue and cash is super important on managing cash inflows. So that's this timing piece. Really understanding the uniqueness of what's going on in these two moments is key to being able to manage cash effectively and planning cash flows and cash reporting well. So when we look at something like a cash flow, a statement of cash flows, one of your three main financial statements, because you don't have perfect accounting, most companies don't, you're not going to have super accurate statement of cash flow, and you need to be managing cash on a weekly basis. One of the elements here is a lot of companies will say, hey, we have a 13-week rolling cash flow. That's good, but like ideally you should be looking out far ahead. And your financial projections should really be also showing a cash projection of like 52 weeks. So you can understand, hey, if I hired 3 salespeople today, what if you have a 6-month deal development timeline? Your cash is going to go way down, and let's just pretend, for example, if this is your weekly cash flow, and it goes like this originally. Well, what if at this point you hired 3 new salespeople? Okay, well, now instead of this is your original, it's going to be a little bit lower actually, and you may even go negative. Let's call that a 0 line. But you know that by hiring those 3 salespeople, you're eventually going to get new deals. So that's where it starts to go like this. But being able to see that inflection point, and what if this is 6 months out? Not 13 weeks. Having that longer time frame enables you to be more proactive in identifying where an issue or challenge may be, so that you don't make this decision saying, hey, we're actually still all good, and this is, this is through week 13. So you're like, oh, great, well, we're hiring them after week 13. So you're not going to have that insight. Being able to see this beforehand, super important. So looking at, we have cash inflows. And you can manage the amount. Ideally, you're going to get paid upfront before you start work. So you can call that a retainer, you can call it a prepayment. That would be considered deferred revenue because you haven't earned it. But you get the cash in now so you can actually afford to spend money to service that client or that product effectively. So you can change the amounts or the timing. And you can front load. So if you have a contract for, let's call it $10,000, could be 100, could be a million, whatever. Instead of, hey, even monthly amounts, what if you said, hey, we get 50% up front? Well, my customer will never do that. Well, you can't get what you don't ask for. So having those conversations and understanding, making sure you have cash in the bank so the car can go forward, you have fuel, that's all that matters, especially going into tough economic times. Next, I'm going to talk about some expenses. So look at that, we kind of went through cash in. Now we're going to talk about cash outflows. These are a multitude of things. They can be COGS, cost of goods sold. This is people, tools, hosting fees, other vendors, W-2, 1099 staff. It's what is it that you're having to spend to create or service the revenue. Then we have expenses, or OpEx. This is like things like G&A, R&D, sales and marketing, things that aren't directly related to creating the revenue, to servicing it, to delivering that revenue. These are important because these are classically called like overhead. And you might have heard like, hey, we got high overhead. Okay, well, what people are talking about are these costs and expenses to run the business. And so when we look at these, there's another outflow for this is how it's running in the future, but in current day, what if you already incurred those? Where are those expenses? They're probably either going to be paid on a credit card or they're going to sit in accounts payable. But so we want to make sure we're reflecting cash outflows as well accurately. So we think of AP, accounts payable, and just like with cash inflows, where you have your current contracted and future pipeline, with AR, accounts receivable, you can change and determine amounts and timing. And you're going to change those amounts and timing based on how cash is projected to come in and what your cash balance is going to be by a week. So you can manage that effectively. We also have, credit card. Got to pay those down, which you could just keep putting that on and never have to pay it back. You also have debt service. So that could be interest. And then there's repayment of principal. So when we look at this, there's a multitude of things that go into cash outflows. There's other unique, maybe one-time things like, hey, you have a severance payment, or hey, you have, some giant legal bill that's non-recurring, but that you're trying to be very discreet about when you're putting what week is it going to hit. So you can have another an other expense area. These are some of the general categories of cash outflows. Now, when we look at how do cash outflows move and why are they moving, there's a few different types of expenses. So we have personnel, and then we have non-personnel. I know it's complicated. So when we look at this, personnel are most oftentimes paid on a weekly, bi-weekly, bi-monthly basis. And some of those personnel are going to be W-2 employees, which also have overhead related to it, taxes, benefits, or their contract labor. 1099 is another thing you might have heard. So the important thing here is with a 1099, maybe you pay them only by the hour they work, which is a much more effective scalable strategy for staffing as opposed to a W-2, where you're going to pay regardless of, unless you're paying them by the hour, if they're a salary employee, you're going to pay them the same amount each period regardless of what they've done. So knowing how personnel expenses are different and the timing, it's important to be specific in how you model those. And when we project it out, we want to make sure that if you're on a bi-monthly, for example, you're reflecting those payments in a bi-monthly cadence. When we look at non-personnel, these things could be, dues and subscriptions, rent, inventory. When we're looking at this, these are all elements of net working capital. And we want to make sure we're accurately capturing the changes in net working capital, so things that are happening on the P&L and the balance sheet, not only accurately, but in a timely component. So we're putting when those expenses or cash inflows, outflows hit in the right week. And so inventory purchases, while your COGS, hey, you're going to have that, whatever you sold, your inventory usage is going to be reflected that way. Yeah, but your inventory purchases or repurchases, those costs will flow much, much differently. So knowing how those costs are different, so you can be accurate in reflecting that spend, is paramount here. Because sometimes inventory can be one of your largest expenses. And so yeah, we're not going to take inventory as a COG and represent that on the weekly cash flow. We're going to make sure we're representing how are we replenishing inventory. So these things are all related, but sometimes they're distinct, separate, and unique. Let's see. And this is also some other non-personnel could come into okay, I would consider interest that would fall in that. You could look at, some of your OpEx like G&A, things like R&D. These are all elements. There's other pieces of this that are important to recognize of how money flows. In particular, when we talk about things like, let's say example, somebody said, hey, great idea, we're gonna do an R&D tax credit. And so all the money you've been spending on R&D, developing out these products that you didn't know if it was gonna work or not, you get a tax credit from the US government for that, which is great. But there's certain elements to it that are important to recognize. How do you get that credit? Certain credits or grants, you may just be given a check, a certain lump sum of money. Or other times, you'll get the credit, but you can really only use it when something else happens. So for certain businesses less than 5 years old, I think it's under 5 million in revenue, if you have an R&D tax credit, you can apply it as an offset to payroll taxes. So even though, let's say the credit was for, you got 100K is what you qualified for. Each period though, you can only use up to that 100,000 an offset to your W-2 overhead. So that's a much different thing on timing and amount than just saying, hey, we got 100K credit, which is gonna greatly change what your cash projection is. And so when we're looking at these things, you're really wanting to break them down, be specific and distinct. Another element here that we'll start talking about, so we just covered cash outflows. So when we start talking about what are the questions that you should be asking? The cash flow is only effective as the assumptions we have within it and how we're accurately portraying those assumptions over time, timing and amount. And so when we look at that, what are some things that we should be talking about? So a cash outflow over here, and we'll do some inflow over here. So some things would be, great, if we hire people, who are we hiring? What do they do? And more importantly, what is the outcome or result of having them on staff? So this is where we talk about, hey, are they a revenue generating resource, sales, marketing, or are they purely business overhead? Maybe your finance person, for example, yours truly, or an operations person. Or they may be a combination of revenue generating and overhead. Now I might consider that like a product person or an engineer. They're not directly creating revenue, but they're creating the vehicle through which we earn money. So it's really important because when we start talking about that, we can then say, well, hey, we just hired a salesperson. Okay, well, what's their quota? When are they going to close deals? How many leads are they going to be bringing in? That's going to change the cash flow drastically. And when we're building up projections, great, let's call this a status quo cash projection. Oh, shit. Oh, wow, things are going, oh. Okay, well, it looks like we have a pretty regular cadence of cash just trailing off, falling off a cliff. Could be a multitude of things. Let's just say maybe that's the bi-weekly payroll. Okay. So we got to manage that because we only have a little itty bitty bit of space here between our cash low points and zero. We have no cash in the tank. We can't go have the car go forward. So at this period, let's say we've only got maybe, this is $1,000 of space. Maybe it's $100,000. I don't really care. Just go with me on the example here. This is when we haven't hired someone. So this is what we call like, hey, this is contracted. Now let's say if we add in pipeline, we know we're gonna go lower initially, but because we've added a revenue generating role, all of a sudden we're gonna get more cash inflows later on. So we're gonna play it out. Here's what the cash line is gonna look with contracted and pipeline income and expenses. So great, so we've hired them. Ooh, we're going a little lower. Coming back up, and we got a short sales cycle, so within a couple weeks we're gonna generate some revenue here. So all of a sudden, oh. So you see this delta, that's the positive impact. So while it was lower here, it's higher here. I know this is a juvenile example, but it's really important when you start to add these decisions up. When you start going to the department leaders and saying, okay, great, you need to achieve these goals over this period of time. There's no such thing as a free lunch. So we have to spend money to make money. So where are we spending? How are we spending? What's the impact of that spend? Hiring is a huge, huge, huge component that is thought of as very straightforward and simple, but the impacts, the results, the outcomes of that hiring, it's really important to be specific about how the cash will change each week from making those decisions. Inventory. Like I said, let's say it costs you 30% is a cost of goods sold. It's a percentage of revenue for inventory. So if you sold $100 of goods, your inventory COGS is going to be $30. And let's say it happened every month. So $30 every month. Okay, for 4 months, that's $120. But let's say you only have $60 of inventory in stock right now. So we have inventory on hand, and so we'll say it's 60. And we say we're going to use 30 every period. And this is assuming we've got $100 positive cash each time. Awesome. You made $100, but you're spending $30, so your gross profit is 70. Awesome. Okay, so at the end of month 1, we have 30 on hand. Then, so now we take this up here, start with 30, now we have 0. Okay, so we can't have negative inventory, so we have to have stuff to sell. So now when we look at this, we say, hey, when are we spending? So we wouldn't represent this is our expense on the cash flow, because that's not accurate. What it is our spend to replenish inventory. And if you've got 30 days lead time to repurchase inventory, you got to put the order in, they need to make it, and then send it to you. It takes 30 days. So you're going to want to make sure you have inventory before the start of month 2, or really early in month 2. So let's say you need to buy $120 worth of inventory. That is your expense that needs to be reflected in cash flow in period 1, and specifically at the end of period 1, or the very early beginning of period 2. That's the expense we want to recognize in the cash flow, in these elements of net working capital and how they change each period, not what's in your COGS there. So certain elements of COGS will be included in a cash flow. Certain elements need to be excluded, but we're not just going to kick them out entirely and not say they're not happening. They're more reflected. This is a balance sheet item, the changes in the balance sheet. So this is where, it's a little bit complicated, but your CFO or your controller should be able to manage this effectively and accurately represent on a weekly basis how our money flows changing. And what can you do to change it? Can you reduce how much inventory it takes to produce the product? Maybe. Maybe instead of 30, it only takes 20. Okay, great. Well, we could kick that out a whole month. That's a big difference. So these are all questions that should be coming up when we talk about how are we purchasing? How are we hiring? How do we spend money and what's the impact of it? Some other elements to be managing cash flow, or questions to ask is, when it comes to hey, rent, pay at the beginning or the end of the month? Okay, for dues and subscriptions. These are online services. You've got your, like, call it your Trello, your Google Suite, your Microsoft fees, your hosting fees, things that are just passively coming in because of activity. But great, is anyone using them? Can you remove them? When do those cash flows, outflows specifically, hit? So let's go over to inflows. So what are some questions that we're going to ask? Okay, great. What are our contracting terms? So what I mean by that is, how are we getting paid? When are we getting paid? And going back to that, is it milestone based? Is it time based? What are our net payment terms? So are you giving net 30 terms? Are you giving net 15? Are you saying, hey, it's due on receipt? Good luck with that. No one pays due on receipt unless you have a credit card on file. What is the method of payment? Is this customer a little antiquated and they send you a check? Are they paying by credit card? Are they paying by ACH? Are they initiating the payment, or are you initiating the payment? Are you processing the credit card, or are they putting it in and entering it? Are you the one drawing the money from their account, whether via ACH, or are they having to process that payment and you send them a link? Those greatly change your cash flows. So, method of payment. Another thing is, how can we speed it up? How do we change the cash inflows? So we could look at, is there factoring available? And so in factoring, invoice factoring, you send the invoice to a customer, let's say it's 100K. Normally they've got, let's say, net 90 terms, so you're gonna wait 90 days until you get paid. There's certain companies that will say, hey, we'll give you the money up front for that invoice, but only a percentage of it. We're not gonna take the whole thing, because we're gonna hold some back and we're gonna charge you that interest. Now, very high fees for this, very high interest, but it can greatly accelerate your cash receipt. So instead of you getting 100K on time zero when you issue the invoice from this factoring company, let's say you're only gonna get like 80%. So you're gonna keep 20% out, so you get 80K. Well, that's vastly different. Now you're probably gonna pay 20, 25% interest on an APR basis for that. But if you need the cash to make payroll, that's a great way to start looking at, how do we accelerate cash? Oh, wow. My spelling got bad there. Maybe it's still bad, we'll see. How do we accelerate? How can we accelerate? When we look at accounts receivable, great, are you dunning? Dunning is, are you calling the customer? Are you contacting the customer to say, hey, your payment's due, where's the money? Kind of like the loan shark calling up, knocking on the door maybe. Where's the money? So when we look at that, we can ultimately see, how do we bring that money in? Are you not doing any AR dunning right now? Hey, when you call someone and say, hey, you owe money, we sent you this invoice, you agreed to it, the reality is you're much more likely to get a faster payment than if you didn't call at all. But there's a lot of tools of, well, how can we automate that dunning? These are all really important elements to be looking at that are going to greatly influence how you can control cash flows and how you can project accurately what's going to change. Because if you're looking ahead, if that's zero, and you say, oh, okay, what are you going to do about this negative? If we know that's, hey, that's 3-4 months out, and we're like, well, we don't have any deals in the pipeline, and this covers, maybe it covers 2 payroll periods. Great. Well, let's not pay the AP that we were planning to pay here. Or let's get more creative about, can we bring in invoice factoring? Can we change some of our staffing? These are not easy questions to be answering, but they're imperative. Otherwise, you're going to be in a situation of, do we save the patient, the company, or do we save the arm?